Imagine waking up on the first day of 2026 with absolutely nothing in your financial corner. No investments, no savings quietly growing somewhere in the background, and no assets waiting to help you move forward. Maybe you have a job that covers your monthly bills, but beyond that, your financial life feels like an empty page. At the same time, the world around you seems chaotic. News headlines keep warning about rising living costs, artificial intelligence replacing jobs, and housing prices climbing higher every year. For many people, this is the moment where they mentally give up before they even begin. They assume the system is impossible to win, so they never try to play the game. But if I had to restart from zero today, knowing what experience has taught me about money, markets, and human behavior, I would not panic. In fact, starting fresh in this kind of environment can actually be an advantage. When you have nothing invested yet, you also have nothing holding you back. You are free to build your financial life correctly from the very beginning without needing to fix years of bad decisions. The plan I'm about to walk through is not some overnight success formula. It's a structured path designed to move someone from financial ground zero toward their first real milestone. Think of it as a roadmap built around clear steps instead of lucky guesses. Over time, following these steps can help someone reach their first serious savings target and eventually build long-term wealth. Before we get into any numbers or strategies, there's one agreement we need to make. This system works only if you follow it in order. Each step supports the next one. Skip a step and the entire structure becomes unstable. To make things simple, this journey is divided into 4 stages. First comes the foundation, then the money engine, after that the investment structure, and finally the wealth protection layer. Every financial strategy that truly works is built on these same ideas, whether people realize it or not. And surprisingly, the first step has nothing to do with investing. Most people believe that the first step toward building wealth is choosing the right investment. They start searching for the perfect stock, the next big technology company, or the latest cryptocurrency that might explode in value. But when someone is starting from zero, the real problem usually isn't finding the right investment. The real problem is the invisible weight quietly pulling their finances backward. That weight is debt, especially the kind with high interest. Many people underestimate how dangerous high-interest debt truly is. Because the payment shows up once a month like any other bill, it starts to feel normal. It sits there next to rent, electricity, and internet, so people stop thinking of it as an emergency. But financially speaking, it is far more damaging than most people realize. Imagine carrying a credit card balance with an interest rate above 20%. Every month, that balance quietly grows, even while you're trying to pay it down. Now think about what happens if you try to invest money while that debt is still active. Even if your investments perform well, a large portion of your progress is being erased by the interest you owe. This creates what I like to call negative compounding. Instead of your money working for you, it is working against you. It's like trying to fill a leaking container. No matter how much water you pour in, the hole at the bottom keeps draining it away. When starting from scratch, the smartest move is not to become an investor immediately. The first role you must take on is something far less glamorous, but far more powerful. You become a debt eliminator. Because mathematically, removing a 20% interest rate from your life is the same as earning a guaranteed 20% return on your money. And opportunities like that are extremely rare in the financial world. Before any investing happens, the financial ground must be cleared. Once you accept that debt is the real obstacle, the next step is deciding how to remove it efficiently. Many people try to pay their debts randomly, throwing small amounts at whichever balance feels most stressful at the moment. Unfortunately, that emotional approach usually keeps people trapped longer than necessary. A more effective strategy is purely mathematical. Instead of focusing on the size of each balance, focus on the interest rate attached to it. List every debt you owe, from the highest interest rate to the lowest. Credit cards usually sit at the top of this list, followed by personal loans or other consumer debt. Then direct every extra dollar toward the debt with the highest rate while continuing to make minimum payments on the others. This method steadily removes the most expensive debt first, which reduces the total interest you will pay over time. As soon as the first balance disappears, the money that was going toward that payment is redirected to the next one on the list. What makes this method powerful is momentum. Each debt that disappears frees up more monthly cash flow, which accelerates the payoff of the next one. Over time, the process begins to feel like a financial snowball rolling downhill. But the benefit of removing debt isn't only mathematical. There is also a psychological shift that happens when you no longer owe money to anyone. Debt quietly limits your choices. It makes people afraid to change jobs, move cities, or take risks that could improve their lives. When that pressure disappears, something interesting happens. Your financial decisions become calmer and more confident. Clearing high-interest debt doesn't just improve your balance sheet. It gives you breathing room, and that freedom becomes extremely valuable when you move to the next stage of building wealth. After the high-interest debt is gone, most people feel a huge sense of relief. For the first time, the money they earn actually belongs to them. At this stage, many beginners rush straight into the stock market because they finally feel ready to start investing. But moving too quickly here can create another serious problem. Life is unpredictable. Cars break down, medical bills appear, and sometimes jobs disappear without warning. If every dollar you have is tied up in investments, even a small emergency can force you to sell those investments at the worst possible time. This is where many new investors accidentally damage their long-term progress. Imagine putting all your savings into the market, and a few months later the market drops by 20%. Normally, this would not be a disaster because markets eventually recover. But if an emergency happens during that drop and you need cash immediately, you are forced to sell your investments at a loss. The moment you sell, that temporary decline becomes permanent. That is why the next step is not investing. The next step is protection. Before buying a single share of stock, a financial safety buffer must exist. Think of it as a shield that protects your investments from unexpected problems. This money is not meant to grow quickly or chase returns. Its purpose is stability. The goal is simple: build a cash reserve that can cover your essential expenses for several months. Rent, food, transportation, utilities, only the basic survival costs. When those months of security sit quietly in a savings account, something powerful happens. You stop making financial decisions out of panic, and that calm mindset becomes a huge advantage once investing finally begins. Building this financial safety reserve may feel slow and even a little frustrating. Unlike investing, where numbers can rise quickly during good market periods, cash savings usually grow at a steady but unimpressive pace. Because of this, many people are tempted to skip this step and jump directly into the market. But patience here protects you later. Think of two different people beginning their financial journey. The first person invests every spare dollar into stocks immediately. The second person spends a few months building a solid emergency reserve before investing anything. At first, the first person appears to be ahead because their money is already in the market. But real life rarely moves in a straight line. Suppose the economy weakens, the market drops sharply, and both people suddenly face a job interruption or unexpected expense. The first person has no choice but to sell their investments during the downturn to cover daily living costs. By selling at a lower price than they paid, they permanently lock in those losses. Even if the market eventually recovers, their money is already gone. The second person, however, has a different experience. Because they built a financial buffer first, they can use their emergency funds to cover expenses while leaving their investments untouched. When markets eventually recover, their portfolio remains intact and continues growing. This difference may look small in the short term, but over many years it becomes massive. A simple emergency reserve allows your investments to survive difficult periods. Without it, even a strong investment strategy can collapse under pressure from everyday life. Once the emergency reserve is in place, the financial structure finally becomes stable enough to begin investing. At this stage, you have eliminated the major threats that usually destroy beginner investors. Debt is no longer draining your money, and unexpected emergencies will not force you to sell investments at the worst moment. Now the question becomes simple but extremely important. Where should the money actually go? Most beginners immediately start searching for the perfect stock. They read headlines, watch market predictions, and look for the next company that might skyrocket in value. The idea of finding a hidden winner is exciting because it feels like a shortcut to wealth. But in reality, stock picking is far more difficult than it appears. Even professional fund managers with huge research teams struggle to consistently beat the overall market. Many studies tracking investment performance over long periods show that the majority of actively managed funds fail to outperform simple market indexes. These professionals have access to better tools, deeper research, and more experience than the average investor. If beating the market is difficult for them, it becomes even harder for someone investing part-time while managing a regular job. Because of this, a smarter strategy focuses on owning the entire market rather than trying to predict individual winners. Broad index funds allow investors to buy small pieces of hundreds or even thousands of companies at once. Instead of betting on one company's success, you participate in the growth of the entire economy. Over long periods of time, this approach has proven to be surprisingly powerful. The biggest challenge with this strategy is not the math. The challenge is that it feels incredibly boring. Boring is not something most people associate with making money. In fact, the financial world often markets excitement. You see headlines about stocks doubling overnight, traders making huge bets, or cryptocurrencies skyrocketing in a matter of days. These stories create the illusion that successful investing should feel thrilling. But in reality, the strategies that quietly build wealth rarely feel exciting at all. Long-term investing often looks almost uneventful. You deposit money regularly, buy the same broad market funds again and again, and then wait. There are no dramatic moments, no constant action, and no daily victories to celebrate. For many people, this lack of excitement becomes a problem because the human brain craves stimulation and quick rewards. This is why many beginners eventually abandon disciplined investing and start chasing risky opportunities. They begin trading frequently, experimenting with options, or jumping in and out of trending assets. At first, this activity feels productive because it creates movement, but over time it usually damages long-term results. One way to manage this psychological challenge is by separating your investments into two parts. The first and most important part is the core portfolio. This is where the majority of your money lies. Around 90% of your investments are placed into low-cost index funds that represent the overall market. These funds are purchased consistently and left alone to grow over time. The second part is much smaller and acts as a pressure valve for curiosity. A small portion of your money can be used to explore individual stocks, new technologies, or other speculative ideas. If those bets succeed, it's a bonus. If they fail, the core of your financial plan remains untouched. By this stage, the structure is starting to look solid. Debt has been removed, a financial safety reserve exists, and investing has begun through a disciplined approach. However, there is another hidden factor that quietly eats away at long-term wealth if people ignore it. That factor is taxes. Many beginners focus entirely on investment returns. They spend hours comparing funds, studying charts, and trying to improve their portfolio performance by a few extra percentage points. But what often goes unnoticed is that taxes can quietly remove a large portion of those gains over time. Where your money is invested can be just as important as what you invest in. A common mistake is placing all investments inside a regular brokerage account simply because it is the easiest option to open. These accounts are flexible and allow withdrawals at any time, but they offer very little protection from taxes. Profits from selling investments can be taxed, and even dividends paid by certain funds may create yearly tax bills. Over decades, this tax drag can significantly slow down the compounding process. Fortunately, the financial system provides several types of accounts designed to encourage long-term saving. These accounts offer special tax advantages that allow investments to grow more efficiently. For example, many employers provide retirement plans where contributions can receive matching funds. This match is essentially extra money added to your investment simply for participating. Other accounts allow investments to grow without taxes being applied when withdrawals are made later in life. When used correctly, these structures protect a large portion of your gains from being reduced by future tax obligations. Choosing the right account structure can quietly add thousands to your long-term wealth. Understanding tax advantages is powerful, but using them correctly requires a clear order of operations. Many people simply invest wherever it feels convenient, without realizing that the sequence in which money is placed into different accounts can significantly affect long-term results. A smarter approach is to follow a structured flow. The first priority should always be capturing any employer retirement match that is available. If your workplace offers a retirement plan where the company contributes additional money when you invest, ignoring that opportunity is like leaving free income on the table. Even a modest match can dramatically accelerate the growth of your investments over time. After securing that match, the next step is focusing on accounts that allow your investments to grow with favorable tax treatment. Some of these accounts allow contributions that later grow completely tax-free, while others reduce the taxes you owe today by lowering your taxable income. These advantages might seem small in the short term, but the impact becomes enormous over several decades of compounding. Money that grows without constant tax deductions simply has more room to expand. Only after these tax-advantaged spaces are fully utilized does it make sense to place additional investments into standard brokerage accounts. Those accounts are still useful because they provide flexibility and easier access to funds, but they should usually come after the more protected options have been filled. This step may not feel exciting because it involves understanding rules and account types rather than picking investments. However, choosing the correct structure ensures that the wealth you build stays in your hands rather than slowly leaking away through avoidable taxes. By now, all the foundations are in place. High-interest debt eliminated, a cash reserve for emergencies secured, a disciplined investment plan started, and tax-advantaged accounts fully utilized. But there's one final and often overlooked factor that determines how fast your wealth grows: your earning power. No matter how frugal you are, there's a limit to what saving alone can achieve. Defense, cutting expenses, avoiding debt, and optimizing taxes prevents loss, but it doesn't accelerate growth. To truly build substantial wealth, offense is required, and offense comes from increasing your income. This is where skill development becomes crucial. Look at your current job or career path and ask yourself, what is the one skill that, if mastered, would make me highly valuable and irreplaceable? It could be coding, data analysis, specialized sales, project management, or even public speaking. Dedicate focused time, an hour a day, for example, to learn and practice this skill consistently. Within months, this new ability can be leveraged to earn a raise, secure a higher-paying position, or start a profitable side venture. A higher income not only accelerates the speed at which you can save and invest, but it also compounds through tax-advantaged contributions, employer matches, and larger monthly investments. Combine this with all the previous steps, and you have a complete, repeatable system. Pay off high-interest debt, build an emergency fund, invest systematically in low-cost index funds, maximize tax-protected accounts, and increase your income through skill growth. It's not glamorous. There are no overnight wins. But over years, this disciplined approach almost guarantees financial growth. The key is patience, consistency, and strategic focus. Start at zero, follow the steps, and over time, The math works for you, not against you. This is how you move from zero to your first 100,000 and beyond, safely, reliably, and without relying on luck or speculation.